Most people don't fail at building wealth because they pick the wrong stocks or don't earn enough money. They fail because they quit during what I call the silent phase. There is a period in wealth building, usually lasting about a decade, where the math of compounding feels completely broken. You save, you sacrifice, you invest, and yet nothing impressive seems to happen. The numbers move, but they move so slowly that it feels like you're walking in place. This is the exact moment where 90% of people abandon the strategy. They assume it's not working, or that they started too late. But the truth is, the math isn't broken. It's testing you. Today, we're going to break down the 10-year compounding rule and why 90% fail. We will cover exactly how to survive the invisible years so you can reach the acceleration that comes after. If you are ready to stop chasing hype and start building clarity, make sure to subscribe to the channel. Let's get into it. The 10-year compounding rule isn't something you'll find in a standard economics textbook, but it is the most critical psychological hurdle in investing. The rule states that for the first 10 years of your investing journey, your results will be dominated by your own contributions, not by investment returns. Mathematically, this happens because compounding needs a critical mass to become self-sustaining. In the early years, your snowball is simply too small to gather much snow on its own. If you save $10,000 and earn a 7% return, you've made $700. That $700 is mathematically correct, but emotionally it feels insignificant compared to the effort it took to save the initial $10,000. You did 93% of the work. The market only did 7%. This creates a massive gap between expectation and reality. We are taught that money works for you, but for the first decade, you are working for your money. The 10-year rule is the acceptance that this heavy lifting is a feature, not a bug. The curve of exponential growth is almost flat at the beginning. It doesn't look like a rocket ship taking off, it looks like a flat line. Understanding this biological reality of math prevents you from judging your progress too early. You aren't failing, you are simply in the accumulation phase that makes the future explosion possible. The reason the first decade feels like a scam is that human beings are not wired to understand exponential growth. We are wired for linear progression. If you work for 1 hour, you expect 1 hour of pay. If you walk for 30 minutes, you expect to cover a specific distance. Cause and effect are usually immediate and visible. Compounding breaks this contract. In the first few years, you are pouring significant resources, your income, your discipline, your lifestyle sacrifices, into a black hole that barely echoes back. You might look at your account balance after 3 years of aggressive saving and think, is this it? The gap between your sacrifice and the visible reward is at its widest point right now. This is why it feels like failure. It feels like you are pushing a boulder uphill with no momentum helping you. Most people interpret this lack of momentum as a sign that their strategy is wrong. They think, I must be in the wrong assets, or I need to trade more actively to speed this up. But this feeling of stagnation is actually evidence that you are building the foundation. You cannot have the skyscraper without the hole in the ground. The first years feel like failure because you are measuring the height of the building while you are still pouring the concrete for the basement. We need to talk about the biggest silent killer of wealth, and it's not inflation or market crashes, it is boredom. The financial industry is built on entertainment, flashing lights, breaking news, and the constant promise of the next big thing. But real wealth building is agonizingly boring. It is the same boring transfer into the same boring index funds or assets month after month for years. When results are slow and the process is dull, the brain craves stimulation. This is the boredom trap. You start to feel that because your investments aren't exciting. They aren't working. You see a friend making 300% on a speculative coin, or hear a story about a tech stock exploding, and your reliable, slow-growing portfolio feels like a mistake. This is where people sabotage themselves. They stop their automatic contributions to chase something faster. But excitement in investing is almost always a proxy for risk. If your investing strategy is exciting, you are probably gambling. If it's boring, you are probably compounding. The goal is not to be entertained by your money. The goal is to be supported by it. I'd love to hear from you in the comments below. Have you ever felt the urge to change your strategy just because it felt too slow or boring? Let's talk about how you handled that urge. Surviving the 10-year rule requires a fundamental shift in identity. You have to stop thinking like a consumer or a speculator and start thinking like an owner. A consumer looks at $1,000 and thinks about what it can buy today. A speculator looks at $1,000 and thinks about how quickly they can flip it into $2,000. An owner, however, looks at $1,000 as a seed. They understand that once that capital is deployed, it is no longer money to be spent. It is an employee that has been hired to work forever. When you adopt the owner mindset, the silence of the first decade becomes bearable because you aren't looking for a quick exit. You are looking to accumulate assets. You stop checking the price of your assets every day in the same way a landlord doesn't check the Zillow estimate of their rental property every morning. The price fluctuation is irrelevant to the long-term utility of the asset. Owners respect the gestation period of capital. They know that a business takes time to mature and a portfolio takes time to compound. By viewing yourself as a collector of assets rather than a trader of paper, you detach your emotions from the daily noise. You aren't losing time. You are acquiring equity. This shift protects you from the urge to interrupt the compounding process. If you can survive the first decade without interrupting the process, something magical happens. The math flips. This is the point in the exponential curve where the line stops being flat and starts to bend upward vertically. Around year 10, give or take, depending on your savings rate and returns, your investment returns start to rival and eventually exceed your annual contributions. This is the crossover point. Suddenly, the portfolio generates more growth in a good year than you could possibly save from your salary. The snowball is finally big enough to roll on its own. The heavy lifting you did in the first decade pays off here. You realize that the $10,000 you struggled to save in year 1 has now doubled or tripled, not because you worked harder, but because it sat there. The silent phase ends and the acceleration phase begins. The tragedy is that most people quit right before the bend. They endure the hard years, get discouraged, and exit just as the math is about to turn in their favor. Understanding that this bend is inevitable, but delayed, gives you the stamina to wait for it. You aren't waiting for a miracle. You are waiting for the math to complete its cycle. A common objection to the 10-year rule is, I'm 40 or 50. I don't have time for a silent decade. This is a dangerous mindset because it leads to desperation. When you feel like you are running out of time, you take excessive risks to catch up, which usually leads to losing what little capital you have. The truth is, the 10-year rule applies regardless of your age, but starting late actually gives you a psychological advantage if you frame it correctly. When you are younger, you have time, but often lack discipline and income. When you start later, you likely have a higher income and a more serious perspective on the future. You can force the compounding curve to bend sooner by contributing more aggressively. While you cannot manufacture time, you can manufacture intensity. A larger shovel, more savings, can compensate for a shorter runway. Furthermore, even if you start at 50, you are likely investing for a time frame that extends into your 80s. That is 30 years, 3 full decades of compounding cycles. The silent phase might still exist, but because you are starting with more urgency and perhaps more capital, the absolute dollar amounts grow faster. The math doesn't discriminate based on age. It only discriminates based on consistency. Starting late is always superior to never starting because you think it's too late. The first 10 years test emotional control more than financial knowledge. Fear appears during downturns. Doubt appears during stagnation. Greed appears when others seem to be doing better. Each emotion pushes you toward abandoning the process. Compounding cannot survive emotional interference. Every panic exit or impulsive shift interrupts time, and time is the engine. Emotional discipline doesn't mean ignoring reality. It means understanding that short-term discomfort is not a signal to act. It is merely the price of admission for long-term returns. Those who succeed long-term learn to separate feelings from decisions. They create systems that operate regardless of their mood. They allow discomfort to exist without reacting to it. This emotional restraint compounds just like money does. Over time, calm becomes habitual. Confidence replaces anxiety. The 10-year rule quietly rewards those who learn to sit with uncertainty without trying to escape it. The market is designed to transfer money from the active to the patient, and your emotions are the mechanism that facilitates that transfer. Controlling them is the only way to ensure the transfer goes to you, not from you. We touched on the boredom trap earlier, but we need to reframe boredom completely. Boredom is often interpreted as stagnation, but in compounding, boredom is a sign that the system is working. When investing feels dull, it usually means you've removed unnecessary complexity and noise. Compounding thrives in simplicity. Excitement often signals risk, not opportunity. If your financial life feels like a roller coaster, something is wrong. The most productive periods of wealth building are often the least interesting. Automated contributions, steady habits, and minimal intervention create the environment compounding needs. Boredom protects you from overreacting. It keeps costs low. It keeps decisions infrequent. Those who learn to appreciate boredom gain a significant advantage. They stop searching for validation and start trusting the process. The 10-year rule rewards those who don't confuse calm with failure. When you feel bored, realize that you have reached a level of systemization that most people never achieve. You have automated the most difficult part of life. Lean into the boredom. Let it be the quiet hum of a machine running perfectly in the background. One reason the first decade feels discouraging is that people measure progress incorrectly. They focus on outcomes instead of inputs. They look at the current balance and feel bad, instead of looking at total contributed and feeling proud. In compounding, success is staying consistent, not seeing rapid growth. You cannot control the market returns in any given year. You can only control your savings rate and your time in the market. Therefore, measuring yourself by market returns is a recipe for frustration. Instead, track contributions, habits, and time invested. These provide a more accurate picture of your discipline. Progress exists long before it becomes visible. It's like bamboo. It grows underground for years, establishing a massive root system before shooting up 80 feet in a few weeks. Shifting how you measure success makes patience sustainable. The 10-year rule becomes manageable when you stop expecting short-term confirmation. You don't need constant proof. You need direction. Over time, correct measurement keeps motivation intact and prevents unnecessary changes. Focus on the streak of monthly investments, not the dollar value of them. Compounding quietly transfers wealth from the impatient to the patient. Those who exit early fund the opportunities of those who stay. This is a brutal but true reality of the market. When someone panic sells during a downturn because the silent phase was too painful, they are selling their assets at a discount to someone who understands the 10-year rule. This transfer isn't dramatic. It happens slowly, through time and behavior. The 10-year rule acts as a filter, removing those unwilling to wait. Those who remain benefit from reduced competition and increased opportunity. Wealth doesn't disappear when people quit. It changes hands. Understanding this dynamic reframes waiting as participation in a long-term advantage. You aren't just holding. You are actively positioning yourself on the receiving end of this transfer. Patience isn't passive, it's strategic. By simply remaining in the game when others leave, you are increasing your share of the future growth. Financial freedom doesn't arrive as excitement. It arrives as calm. It's the absence of urgency, the ability to choose. The confidence that time is working for you instead of against you. Those who survive the 10-year compounding phase often describe freedom not as abundance, but as stability. It's the moment you realize you can handle an emergency without panic. It's the moment you realize you can leave a toxic job because you have a runway. This stability is built quietly, without spectacle. It's the result of decisions made consistently long before results appeared. The 10-year rule doesn't just build wealth. It reshapes how you experience life. Time becomes less threatening. Choices become clearer. Stress recedes. This is the real reward compounding offers. It buys you out of the rat race, not by making you a billionaire overnight, but by giving you control over your own time. And that control is worth every single boring, silent year it took to get there. The 10-year compounding rule exists because it's uncomfortable. It demands patience in a culture obsessed with speed. It asks for discipline without applause, but it works. Compounding doesn't reward those who move fastest. It rewards those who stay longest. If you can survive the invisible years, the process becomes self-reinforcing. Time takes over. Discipline compounds. Progress accelerates quietly. Financial freedom isn't about brilliance or timing. It's about staying when leaving feels justified. If you want a clear, calm way to track this long journey, without the noise or the hype, we are building the Trip to Wealth Command Center to make invisible progress visible, so patience becomes easier to sustain. Because real wealth isn't built overnight. It's built by trusting the process long enough to let time finish the work. Join the early access waitlist of the tool below and lock in an exclusive discount. Remember, this video is for educational purposes only and does not constitute investment advice. It is important to conduct thorough research and consult with financial professionals before making any investment decisions. The value of investments can fluctuate, and past performance is not indicative of future results. If you found value today, I highly recommend watching my next video. Don't forget to like, share, and subscribe to our channel. I appreciate your support more than you know. Until next time, stay consistent, stay patient, and stay winning. We'll see you in the next video.